Hey traders, ever feel frustrated when a moving average crossover gives you a signal, but then price does the opposite? Today, I'll show you how to master the moving average crossover strategy in a way that avoids false signals, catches strong moves, and gives you real consistency. We'll break down how to read moving averages the right way, why most crossover strategies fail, and how to boost your win rate by following just a few key steps. Let's get started. First, what exactly is a moving average? It's a line on the chart that shows you the average closing price over a number of candles. It smooths out the noise and helps you spot the real trend. You can use a 20-period moving average for short-term trend, a 50-period moving average for medium trend, and a 200-period for the long-term direction. If price is above the moving average, the trend is up. If price is below the moving average, the trend is down. Simple, but powerful. Now here's where most traders mess it up. They see a crossover, like the 20 crossing above the 50, and instantly take a trade. Buy when it crosses up, sell when it crosses down. Sounds smart, but in reality, it's risky. This kind of entry only works in strong trending markets. In a sideways or ranging market, you'll get faked out again and again. And if you're using too many moving averages, you'll get late entries and worse results. Also, trading this strategy on lower time frames, that's a trap. Lower time frames are full of noise and fake signals. You need a better way. Here's how professional traders actually use the crossover strategy. Use just two moving averages, a 20 period and a 50 period. Stick to higher time frames like 15-minute, 1 hour, or even 4 hour. This gives cleaner, more reliable signals. And now, the golden rule: only trade the next crossover if the last two crossovers were both successful. Let me explain. Look back at the two most recent crossover signals. Did price actually follow through in the same direction after the cross? If both were profitable moves, you can trade the next signal with confidence. But if even one failed, skip the trade. This one filter will protect you from most bad setups. Let's walk through a real example. Imagine you're on a 15-minute chart. You see the first crossover, 20 crosses above the 50. Price continues to move upward. That's a win. Second crossover, 20 crosses below 50. Price drops afterward. That's another win. Now we get a fresh crossover upward. Since the last two were successful, we enter a buy. We place our stop loss just below the recent swing low and set a target that's twice the size of the stop. Price moves in our favor. Trade hits target. Clean win. Now imagine if the last two crossovers had failed. Would you still take the next signal? Of course not. This one simple rule filters out low quality trades. Want to make this even more powerful? Add a trend filter using a 200-period moving average. If price is above the 200, only take buy signals. If price is below the 200, only take sell signals. It helps you trade in the direction of the larger trend. This one filter can turn a 38% win rate into a 48% win rate just by avoiding trades that go against the main flow. Combine this with the two successful crossover rule, and your strategy becomes much stronger. Here's another tip. Use moving averages as dynamic support and resistance. Price often reacts to them, bounces off them, or rejects from them. For example, if price keeps bouncing off the 50-period moving average multiple times, and you see an overbought reading on the RSI indicator, that's a high probability short. Or if price dips to the moving average and the RSI indicator shows oversold, you've got a solid long setup. You're not just reacting to signals, you're trading with confluence. Let's recap everything. Use just two moving averages, 20 and 50. Trade on higher time frames. Only take the next crossover if the last two were both successful. Use a 200-period moving average to stay with the trend. Treat moving averages as dynamic support and resistance. These rules aren't complicated, but they work because smart trading isn't about being perfect. It's about stacking the odds in your favor. If this strategy makes sense to you and you're tired of getting faked out by the markets, start testing it. backtest it, build confidence with it, and if you want more simple, high probability strategies just like this, don't forget to like this video and subscribe. This channel is all about real education, not hype. Thanks for watching, and I'll see you in the next one.